Right now I want to teach you about some exceptions to the early distribution penalty. That is a test when you take out your IRA account, individual retirement account, or your 401k or another tax favored account when you take it out early. So those accounts, the law is that, the tax law, if you're under age 59 and a half, you're not supposed to withdraw the money in those accounts. And that money is tax deferred, meaning that the money that's been placed into those accounts, say for your 401k for instance, has not been taxed. Therefore, when you pull out the distribution, or when the taxpayer pulls out the distribution, it will be taxed as income. In addition to that, they have a special penalty, which is, you would say, encouraging people to leave that money in the account until they reach age 59 and a half. So that age 59 and a half is the cutoff. If you pull out the money from that account before age 59 and a half, you will be subject to tax penalties. And the tax penalty rate is 10% for the federal, so 10% extra penalty on whatever the distribution amount is. And then also the state of California has a 2.5% early distribution penalty, which also can be a little bit painful. So let's say that you pull out $20,000 from your 401k plan and you are under age 59 and a half, you'll have to pay an extra penalty, 10% to the feds and 2.5% of that amount to the state. And you really have to keep in mind that this penalty, or these penalties, are in addition to your regular income tax. So you're actually paying income tax when you're drawing out that $20,000, and then on top of your regular income tax, both federal and state, you're also having to pay those two penalties, again, federal and state. So to make a long story short, it is a very brutal tax-wise. The tax system very much punishes, you could say, the early withdrawal of those tax-favored accounts, the IRA, the 401k, anything where it's money that has not been taxed. So let's give an example of someone who is in the 25% federal tax bracket, and let's say they're paying 5% for state income tax. If they're taking out that $20,000 distribution, they're not only going to have to pay that 25% federal income tax and the 5% regular state income tax on the amount, but also in addition to that, another 12.5% on top of those amounts, okay? So you can see that, between 10% federal and 2.5% state, when that goes on top of the regular tax rates, you're now up into the 40% of your money will be disappearing when you pull out that withdrawal. So generally speaking, as a tax preparer, this is one of the most discouraged things in the tax system, and for your clients, you need to know that. A lot of people will ask you, you know, I need to get some money to pay off some credit card bills, I'm going to pull out of my 401k. You have to be able to understand that that's a very expensive way to get money. Pretty much any other way is going to be cheaper than paying 42% or some very high percentage like that. So similar to what happens to self-employed people with that self-employment tax is the overall rate on the early distribution can be extremely high. Now fortunately, and this is where your knowledge as a tax preparer comes in, there are certain exceptions to the early distribution penalties related to IRAs, 401ks, and these other tax deferred accounts. So you really, as a tax preparer, you have to know what these exceptions are so that if you're dealing with a client who has already taken a distribution of, say, that $20,000, if you as a tax preparer, your knowledge to know what those exceptions to the penalties are, you can save that taxpayer and your client a good amount of money. So you definitely want to be knowledgeable in this area. So whenever you have a client that comes in with a 1099-R is the form that when you pull out from your retirement account, that's the form, just like a W-2 is for wages, that's for retirement income. And so you'll see on that form that there's a box marked that says it's an early distribution, meaning that taxpayer is under age 59 and a half. Now, as a tax preparer, the first thing that you need to think of on behalf of your client is, okay, this person has taken out their 401k or their IRA, whatever account it may be, they've taken it out early. Will this taxpayer be able to qualify for any of the exceptions to the early distribution penalty? So you need to kind of be in that mode of, is it possible that this person won't have to pay the penalties on this withdrawal? The first exception to the rule that you have to pay a penalty that you need to be aware of is when the money from the retirement account is withdrawn in order to have a down payment for a home purchase, for a first home purchase. So when you take out up to $10,000 from a retirement account, that normally would be subjected to that 10% federal and 2.5% state penalty. But if you use that money as down payment on a home, you may be able to avoid those penalties. Now, secondly, so let's say you're dealing with someone who's not quite age 59 and a half, but say they're 56 years old. There's an exception when you're separated from service and you're age 55 or over. So let's say that someone got laid off when they were 55 and they essentially started taking out their retirement income at that time because they had gotten laid off and they don't have their wage income, so they need that money to live on. That person is able to qualify or may be able to qualify for an exception and not have to pay the penalty. Thirdly, if the distribution is due to death, so let's say that taxpayer dies and the beneficiary of that retirement account, let's say that it's a father who has marked his daughter as the beneficiary. Now she receives that IRA distribution from the father due to him passing away. She would not have to pay the penalties, the federal and state penalty on that amount because the distribution was caused by the death of the taxpayer, of her father. Also, there's a possible exception when medical expenses are involved. So a lot of people, unfortunately, many of the personal bankruptcies in the country are related to medical bills and large medical bills, and one way that people can get money in order to pay a lot of bills that they may owe is through pulling out of their 401k or their IRA account. So if the money that's drawn out is used to pay for medical expenses, you may be able to qualify that taxpayer for an exception and again avoid that 10% federal and 2.5% state penalty, tax penalty. There's another exception for somebody who is unemployed and is paying for health insurance with the distributed funds out of the retirement account. So whenever you're dealing with a client that's unemployed, you want to just quickly look and see, hey, did you have health insurance when you're unemployed, and is that the reason why you took out this money from your IRA account? It's not something that happens every day, but it's something to keep an eye on, definitely. Another exception is, and this one you will see more commonly, is when people will withdraw their 401k or IRA account in order to pay for college, okay? And this would apply if it's for yourself, your spouse, or also for any dependents. So let's say that a taxpayer takes out $20,000 from a 401k account in order to pay for his son's college. To the extent that the money that's drawn out is used to pay for higher education expenses, so either college, trade school, something post-high school, you can avoid the tax penalty on that amount if it is used for higher education expenses. Last but not least, when you have an IRS levy, so the IRS is basically attaching your property and you owe a back tax debt, they have an exception where to erase or to release an IRS levy that's been placed on say, your bank account, you can draw out your 401k or IRA or other tax-deferred account. You can draw out that funds to release the levy. So in other words, to take that money and pay it off to the IRS, pay the debt that you owe, you will not have to pay that early withdrawal penalties for federal and state if that's the purpose that the funds are being used for. So this is really something where you have to kind of look at your client, and when you see that 1099-R form with that box marked as early withdrawal, you think to yourself, okay, what's this person's situation? Why did they pull out this money? Was it for college? Was it because they were unemployed and they needed health insurance? Is it because they owed the IRS money and they had to pay the IRS, so this was their only asset that they were able to pull money out of? Are they an older person that's not quite 59 and a half, but they've been laid off? You really have to delve into why did the client need that money, and then from the perspective of a tax preparer, you want to see if you can qualify the client to avoid those penalties. One of the reasons why we highlighted the exceptions to the early distribution penalty as something that we wanted, as a topic that we wanted to do a special instructional video on, is that as a tax preparer, you really have to realize that there's certain situations where you prove your value, you prove your professionalism. You know, one of those situations is dealing with somebody who's self-employed and helping them, you know, find the deductions that are applicable to their line of business. That's a great way to show that you're a professional and it's worth whatever the fee the client is paying you. You're saving them money, you know, you're making a positive impact on their finances. And this is another area, this early distribution penalty, where if you know, can apply your knowledge. So first of all, you have to have that knowledge. You have to know what are the exceptions to the early withdrawal penalty. And you not only have to have that knowledge, or at least know that it's available and you can look up what the exceptions are, but you have to apply it on the taxpayer's behalf. So when the taxpayer is coming to you and they've drawn $20,000 out of their IRA or 401k, and you're going to be able to qualify them for an exception to save them that 12.5%. Okay, 12.5% of $20,000 is $2,500. So that's a good amount of savings. And that's something that by knowing what you're doing, you're going to be able to save your client a good amount of money, and that client is going to remember that. They're going to be impressed and, wow, you just saved me $2,500. And that's the kind of client, when you use your knowledge in these specialized situations to save the person money, that client will then go and tell, hey, this guy or this person, this lady really knows what she's doing. She saved me $2,500 on my early distribution of my retirement plan because she knew about XYZ exception, whatever you've qualified the client for. So it's really one of those you know, situations as a tax preparer where you can be the hero of the situation, and it really will make a great impact on your client. It'll let them know, hey, this is why I'm going to a professional tax preparer, because this person has studied these rules and knows this and is able to save me money in this way. So avoiding early distribution penalties on IRAs and 401ks is something to be definitely familiar with, because when it does come up, it's an area where you can save your clients real money. And that's what doing taxes is all about.